It's for CA into financial management, newly added series. This is chapter of cost of capital. In this illustration, there is no newly added questions. In practical problem number 7, there is a newly added question in new syllabus. And let's get started. Company issues 15% convertible debentures, which is 100 each at par with a maturity period of 6 years, which is convertible debentures, which is redeemable debentures. On maturity, each debentures will be converted into 2 equity shares of the company. Risk-free rate of return is 10%, market risk premium is 18%, and beta of the company is 1.25. The company has paid dividend of 12.76 per share. 5 years ago, it paid a dividend of 10 per share. So with the help of this, we have to find the growth rate, and flotation cost is 5% on issue amount. This is the data given for debentures, convertible debentures. And next, for preference shares, 5% preference shares of 100 each, premium of 10%. These shares are redeemable after 10 years at par. Flotation cost is 6% of issue amount. Assuming corporate tax is 40%, they have given data for convertible debentures and preference shares. They asked us to find out the cost of convertible debenture using approximate method and YTM method to calculate cost of preference shares. YTM method is taking randomly some percent and finding out the answer, but cost of capital using approximation method is we have to use the formula to calculate it. Let's get started, guys. Wrote down what is given in the questions. For debentures, par for 6 years it is convertible, and risk-free rate and risk premium, beta, and dividend which is paid, and 5 years ago dividend is 10 rupees, and flotation cost which is 5%. First of all, we just complete debentures using approximation method, and let's get started. First of all, with the help of these data, we first find out the percentage of KE, which is KE is equal to RF plus beta, RM minus RF. All the data are given. Risk-free rate, which is 10%, plus beta 1.25, and this data also given, which is 18%, which we can find out as 1.25 into 0.18 plus 0.10, which is 32.5%. And then with the help of this dividend, we find the growth. This is dividend in 6th year, which is 12.76. This is maturing after 6th year. So in foundation, we found this formula, which is future value is equal to present value 1 plus r to the power n to find out the future value of the present value. In this, we consider the dividend as future value and present value, which is in 5th year. Before 5th year, 10 rupees, 1 plus r we consider growth, and number of years is 5 years. So 12.76 divided by 10 plus 1 plus g to the power 5. 12.76 divided by 10, which is 1.276. When this 5 goes there, which become cube root 1 plus g. Let me find out this 1.276. This is a shortcut to find out this cube root. So first we have to write the number 1.276 and press root for 15 times. Then minus 1 divided by, what is the root here? 5. So 5 plus 1 and press multiplication and equal to 4 another 15 times. And which we got is 1.0499 is equal to 1 plus g. When we minus this, we get 0.0499 is equal to g. which is nothing but 4.9, which is approximately 5% growth rate. Just found out KE and growth rate. Now we have to find the value of the share in 7th year, which is D7 by KE minus G. This cost, and this is what we pay, which is dividend in 7th year is, they have given the dividend is 12.76, and we found out the growth rate is 5%. So 1 plus 0.05 divided by KE, we just found out here 32.5 minus growth rate, which is 5%. When we calculate this, we get the answer. Dividend is calculated for 7 years. Normally we calculate for 1 year, so you have to do it for 7 times. 1.05 for 7 times, which is 1.407. 12.76 into divided by 1.225 minus 0.275. And we get present value of shares, which is 65.28. This is present value of 1 shares. After 6 years, the shares are converted into debentures are converted into 2 equity shares. So redeemable value will be 65.28 into 2, which comes to 130.56. Now we just found out all the data necessary for finding using the approximation method for debentures. The formula is KD is equal to interest 1 minus tax plus redeemable value minus net proceeds by number of years, all divided by redeemable value plus net proceeds by 2. In this, we just found out redeemable value and net proceeds, which is net proceeds 100 rupees is the value of debentures, and minus flotation cost, which is 5%, and it comes to 95. And then interest 15% debentures to 100 rupees, 15%, which comes to 15 rupees, and 1 minus tax rate they have given as 40%, plus redeemable value 130.56 minus net proceeds we just found out as 95, divided by number of years of debentures, which is 6 years, and then divided by redeemable value 0.56 plus 95 by 2. When we calculate that, we get the answer. Numerator it is 1.926. Denominator it comes to 112.78. 14.926 divided by 112.78, which comes to, when we write it as percentage, which is 13.23 percentage. Yeah, we just completed the cost of convertible debentures. Let's recap what we did first. First, with the help of the risk-free rate, we found out the KE, which is cost, and after that, with the help of the dividend, we found out the growth rate, and after that, we found out the value of shares. The P6 on 6th year, the value of shares we found out by using the formula, and this is calculating the cost of KD. This is cost of equity, which we found out earlier, and this is cost of debentures. It is absolute necessary for preparing this. KD is interest 1 minus tax, redeemable value minus net proceeds by n, and divided by redeemable value plus net proceeds by 2. Interest they have given in the question, which is 15%. Tax also given. Redeemable value just found out by multiplying the value of shares into 2, And after that, net proceeds, it's after deducting flotation costs, which comes to 95, and after substituting we got 13.23 percentage. Now we go on for preference shares, which is 5% preference share, 100 par and 10% premium, and it for 10 years, and flotation cost is 6%. With the help of this, we're gonna find out the cost of preference shares. Calculate using YTM method for preference shares, and for debentures we found out using approximation method. For preference shares, to find out using YTM method, we have to find the cash flows, which is net proceeds. Net proceeds, which is 100 rupees, which is value of shares issued at premium, which is 10%. Then 110 rupees is the value of shares, and we have to deduct flotation cost, which is 6%, which comes to 6.66. When we deduct 110 from 6.66, we get 103.40. This is the cash flow at the beginning of the year. And so here, at the beginning of year, we have to pay 30.40, and 1 to 10 years we will pay preference dividend, which is 5%. For preference dividends there is no tax, so we will have to pay 5% totally. There is no tax benefit, and at the end of 10th year we will get back, we will pay back 100 rupees. And YTM method we have to calculate using, in this they have given only 3% and 5% present value factor. So with the help of this, we have to find out the preference shares. So add the total of 3% and add the total of 5%, and first of all I'm taking for 5% and then for 3%. Here I will write the cash flow. Year 1 we will get this, and we will pay for 10 years 5 rupees, and PV factor, which comes to 1.723. and at the end of the third year, 10th year, which is 0.164, and for 3% it is 744, and for 10 years it comes to 940. Which is 8.529. Then we have to find out the IRR. That's it. Then calculation of IRR, which is lower rate, we have to write the lower rate percentage plus NPV at lower rate by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. Then we have to do some calculation, that is we will get the answer. and the answer is 4.6%. And we completed. That's it. Bye guys.